History doesn't repeat, but financial patterns do. And today's story exposes one of the most powerful money mechanisms ever hidden from the public, because what happened in nearshoring capital shift still shapes global finance today. Right now, while the world obsesses over AI, cryptocurrency, and electric vehicles, the largest geopolitical wealth transfer in a generation is happening in complete silence, where billions of dollars in manufacturing capacity are flooding out of China and pouring into Mexico at a pace that economists are calling the fastest industrial transformation since post-war Japan. And this isn't gradual economic evolution, this is a financial earthquake that's reshaping supply chains, labor markets, currency flows, and the entire North American economic hierarchy. Mexico is experiencing what analysts are calling a $1 trillion megaproject boom, where global corporations are investing unprecedented amounts to build factories, logistics hubs, energy infrastructure. And entire industrial cities across the country, and companies like Tesla, BMW, Volkswagen, Samsung, LG, Foxconn, and hundreds of others are constructing manufacturing facilities worth billions each. Not as symbolic gestures or diversification experiments, but as permanent operational centers replacing decades of Chinese production dominance, this is nearshoring on a scale never witnessed before. And if you understand what's driving it, why it's irreversible, and how it creates wealth for those positioned correctly, you'll see why this might be the most significant investment opportunity of the next decade. So let's break down the economics, the strategy, the infrastructure, and the financial patterns that make Mexico's rise mathematically inevitable. For 40 years, China was the undisputed manufacturing capital of the world, where companies offshored production to exploit cheap labor, minimal regulations, and government subsidies that made Chinese manufacturing unbeatable on cost. And by 2019, China accounted for 28% of global manufacturing output, more than the United States, Germany, and Japan combined. But something changed, not gradually but suddenly and violently, because between 2018 and 2025, a series of geopolitical, economic, and logistical shocks exposed fatal vulnerabilities in the China-centered supply chain model, and corporations that had spent decades optimizing for cost efficiency suddenly realized they'd created catastrophic fragility. The trade war, launched under Trump and continued under Biden, imposed tariffs that added 25% to the cost of Chinese imports in key sectors, which sounds manageable until you realize that most manufacturers operate on profit margins between 5% and 15%. So a 25% tariff doesn't just reduce profit, it makes the entire operation economically inviable, and companies faced a choice: absorb losses, raise prices, and lose market share, or relocate production. Then COVID-19 hit and revealed something even more dangerous than tariffs, which was supply chain vulnerability, because when Chinese factories shut down in early 2020, global production stopped completely, where automotive plants in Detroit couldn't get semiconductors, consumer electronics disappeared from store shelves, and pharmaceutical companies couldn't source active ingredients. Corporations discovered that saving 10% on labor costs meant nothing if a single port closure in Shanghai could halt $50 billion in annual revenue. And the Shanghai lockdowns of 2022 reinforced this lesson brutally, where the world's largest container port shut down for months, stranding ships, delaying deliveries, and costing companies billions in lost contracts and penalties. Then came the geopolitical calculation, because Western governments, particularly the United States, began viewing China not as a trade partner, but as a strategic competitor and potential adversary, where semiconductors, batteries, pharmaceuticals, and critical minerals became national security concerns rather than simple economic inputs, and legislation like the CHIPS Act, Inflation Reduction Act, and USMCA trade agreement all included provisions explicitly designed to incentivize manufacturing outside China. The USMCA agreement, which replaced NAFTA, includes rules requiring that 75% of automotive components must originate from North America to qualify for tariff-free trade. And this single provision has driven tens of billions in automotive investment into Mexico, because companies that want to sell cars tariff-free in the United States must now build them in Mexico, or face penalties that destroy their competitive position. Energy costs also shifted dramatically, because China's electricity prices surged as the country struggled with coal shortages and environmental restrictions, while Mexico's energy reforms opened the market to private investment in natural gas, solar, and wind power, creating stable and increasingly cheap electricity, and for energy-intensive industries like steel, chemicals, and data centers, energy cost differences of 20% to 40%. Make relocation financially mandatory. Labor costs in China have tripled since 2010, where the average Chinese factory worker now earns between $800 and $1,200 per month, while Mexican workers in manufacturing zones earn $400 to $600 per month with comparable productivity. And when you factor in shipping costs, tariffs, and supply chain risk, Mexico becomes cheaper than China. Even before considering proximity to the U.S. market, shipping a container from Shenzhen to Los Angeles takes 14 days and costs $3,000 to $8,000 depending on market conditions, while shipping from Monterrey to Texas takes 2 days by truck and costs under $1,000. And for just-in-time manufacturing models where inventory holding costs matter, proximity becomes a competitive weapon, not just a convenience. All of these factors converged simultaneously between 2020 and 2025, creating what economists call a phase transition, where gradual pressure suddenly triggers systemic change, and companies that spent decades building supply chains in China are now spending billions to replicate those supply chains in Mexico, not because they want to, but because the financial math now demands it. This isn't theoretical economic modeling or speculative projections. This is $1 trillion in actual construction, real factories, signed contracts, and operational facilities already producing goods, and the scale is staggering when you examine sector by sector what's being built right now. Tesla announced a $5 billion gigafactory in Monterrey that will produce 1 million electric vehicles annually, making it one of the largest automotive plants in the Western Hemisphere. And this isn't just assembly, it's full vertical integration including battery production, motor manufacturing, and software development, employing 6,000 workers directly and creating an estimated 35,000 indirect jobs in the supply chain. BMW is investing $2.3 billion to expand its San Luis Potosi plant, doubling production capacity to 300,000 vehicles per year, while Volkswagen is spending $4.5 billion upgrading its Puebla facility to produce electric vehicles and expanding into battery production. And General Motors committed $3.6 billion across multiple plants in Coahuila and Guanajuato to produce electric trucks and SUVs for the North American market. Samsung announced a $2 billion electronics manufacturing complex in Querétaro that will produce semiconductors, consumer electronics, and appliances, directly competing with its own Chinese facilities. And LG is investing $1.4 billion in Monterrey to build home appliances, batteries, and EV components, while Foxconn, which is Apple's primary manufacturing partner, is constructing a $700 million facility near Guadalajara to produce iPhones, MacBooks, and other devices. These aren't isolated announcements. They're part of a coordinated industrial transformation where global corporations are replicating entire Chinese industrial clusters in Mexico. Because when Tesla builds a gigafactory, it doesn't come alone. It brings 150-plus suppliers who must locate nearby to provide just-in-time component delivery. So every major automotive investment triggers $2 to $4 billion in additional supplier investments. The logistics infrastructure is equally massive, where Amazon committed $5 billion to build 100 distribution centers across Mexico. Walmart is investing $2.7 billion in supply chain expansion, And DHL is constructing a $1.8 billion logistics network connecting Mexican manufacturing hubs to U.S. distribution centers because nearshoring doesn't work without logistics infrastructure that can move goods faster and cheaper than Chinese shipping routes. Energy infrastructure is receiving $60 billion in investment, where private companies are building natural gas pipelines, solar farms, wind turbines, and grid connections to power the new industrial zones because factories need reliable electricity, and Mexico's energy reforms opened the sector to private capital for the first time in 80 years, creating an investment rush comparable to U.S. energy deregulation in the 1990s. Real estate and industrial parks are booming, where developers are constructing entire cities designed specifically for manufacturing, with purpose-built facilities, integrated logistics, housing for workers, and commercial districts, and companies like Vesta Prologis and Fibra Uno are spending $15 billion building industrial real estate, with occupancy rates above 95%, and rental prices increasing 30% annually in key markets. When you add automotive, electronics, logistics, energy, real estate, and related sectors, the total investment committed between 2020 and 2030 exceeds $1 trillion. And this is documented investment, not speculative projection, because these are construction contracts, signed agreements, and operational facilities already producing goods and employing workers. Not all of Mexico benefits equally from nearshoring because industrial investment follows mathematical rules, where infrastructure quality, labor availability, energy access, and logistics connectivity determine which regions capture billions while others get nothing, and understanding this geographic logic reveals where wealth creation concentrates. The Golden Triangle formed by Monterrey, Guadalajara, and Mexico City receives 70% of all foreign direct investment because these cities have airports, highways, rail connections, universities producing engineers, and established industrial clusters that reduce startup costs, where a company building in Monterrey can hire 500 engineers immediately, while building in Oaxaca requires years training a workforce from scratch. Monterrey specifically has become Mexico's Detroit, where 80-plus automotive suppliers operate within 100 kilometers of major assembly plants, creating an ecosystem where engineers move between companies. Suppliers share logistics infrastructure, and just-in-time delivery works because everything is nearby. And this cluster effect makes Monterrey more valuable than the sum of its individual factories. The U.S.-Mexico border region is experiencing explosive growth because proximity to U.S. markets matters more than almost any other factor, where Tijuana, Juarez, Nuevo Laredo, and Reynosa are becoming manufacturing powerhouses, because products assembled there can reach U.S. distribution centers within hours rather than weeks, and border-adjacent industrial parks charge 40% higher rents than inland locations, precisely because time to market is worth billions. Railway infrastructure is the hidden bottleneck that determines winners from losers, because Mexico has only 27,000 kilometers of railway compared to China's 150,000 kilometers, and the U.S.'s 220,000 kilometers, meaning that moving goods internally requires trucks which are slower and more expensive than rail. And companies investing in Kansas City Southern and Ferromex railway expansion understand that whoever controls rail corridors controls Mexican logistics for the next 50 years. Ports are being transformed from regional facilities into global logistics hubs, where Lázaro Cárdenas on the Pacific coast is receiving $3 billion in expansion to handle container ships from Asia, while Veracruz on the Gulf Coast is being upgraded to serve Atlantic trade routes, and these port investments create strategic choke points where goods entering Mexico must pay fees, creating permanent revenue streams for infrastructure owners. Energy grids are unevenly distributed, where northern states near the U.S. border have access to Texas natural gas pipelines and renewable energy projects, while southern states remain dependent on expensive and unreliable diesel generation. And this energy cost differential alone determines whether a factory is profitable, because aluminum smelting data centers. And chemical production require cheap, stable electricity that only exists in specific regions. Universities and technical schools determine long-term competitiveness, and training costs of $50,000 per worker across 5,000 employees is $250 million before a single product is manufactured. Real estate availability creates physical constraints, concentrating wealth in ways that will shape Mexico for generations. The financial mechanics of nearshoring create currency flows that most people completely misunderstand, because when corporations invest $1 trillion in Mexico, they don't just build factories, they trigger monetary dynamics that strengthen the peso, increase purchasing power, and fundamentally alter Mexico's position in the global financial system. Foreign direct investment requires converting dollars into pesos to pay for land, construction, salaries, and operations. And when Samsung invests $2 billion in Querétaro, it must exchange $2 billion for pesos, creating demand that strengthens the peso against the dollar, and when this happens across hundreds of companies simultaneously, the peso appreciates, making Mexican workers effectively richer in global purchasing power terms. Between 2020 and 2025, the Mexican peso strengthened from 22 pesos per dollar to 17 pesos per dollar, a 25% appreciation that increased real wages for Mexican workers without any nominal wage increases, because a worker earning 10,000 pesos per month in 2020 could buy $450 worth of imports, while the same 10,000 pesos in 2025 buys $588 worth of imports, a 30% increase in real purchasing power. This currency strength creates a virtuous cycle, because stronger pesos mean higher real wages, which reduces emigration to the United States, which keeps labor available for Mexican factories, which attracts more investment, which strengthens the peso further. And Mexico is experiencing the opposite of the currency crises that destroyed Argentina, Turkey, and Venezuela. Capital inflows also increase Mexico's foreign exchange reserves, which were $200 billion in 2020 and exceeded $220 billion by 2025, providing a cushion against external shocks and allowing Mexico's central bank to manage interest rates more aggressively than peer countries, and higher reserves mean lower borrowing costs for Mexican companies and more stable currency, which attracts even more investment. Trade balance transformation is equally dramatic because Mexico traditionally imported more than it exported, running chronic trade deficits, but nearshoring is flipping this dynamic, where Mexican exports to the United States increased from $358 billion in 2019 to $475 billion in 2024, making Mexico the United States' largest trading partner, surpassing China for the first time in decades. Export-led growth creates tax revenue because every Tesla produced in Monterrey generates corporate taxes, payroll taxes, VAT on parts purchases, and customs duties on imported components. And Mexico's federal tax revenue for manufacturing increased 35% between 2020 and 2024, providing funding for infrastructure without increasing debt. And this separates Mexico from countries like Argentina that fund spending through money printing and inflation. Remittances from Mexican workers in the United States reached $63 billion in 2024, but as nearshoring creates high-paying manufacturing jobs, emigration is declining, and economists project remittances will fall 20 to 30% over the next decade as workers stay in Mexico for automotive and electronics jobs paying $15,000 to $25,000 annually, which is comparable to what undocumented workers earn in the United States without the migration risks. Debt dynamics improve because stronger exports and higher tax revenue allow Mexico to refinance dollar-denominated debt at lower rates. And Mexico's sovereign debt yields fell from 7.5% in 2018 to 5.2% in 2025. Saving billions in interest payments annually, and lower interest costs mean more money available for infrastructure investment, rather than debt service. Nearshoring creates concentrated wealth in specific industries, companies, and individuals, while devastating others because industrial transformation never distributes benefits equally. And understanding who wins and who loses reveals the structural forces that will shape Mexico and the broader global economy for the next generation. Automotive and electronics workers in northern industrial zones are the biggest winners, where Tesla engineers in Monterrey earn $40,000 to $80,000 annually. BMW production managers earn $50,000 to $100,000, and even assembly line workers earn $15,000 to $25,000 with benefits, which is 3 to 4 times the Mexican median household income. Creating a new manufacturing middle class that didn't exist before, real estate owners in industrial zones captured extraordinary wealth because industrial land near Monterrey that sold for $15 per square meter in 2015 now sells for $120 per square meter in 2025, an 8x increase in a decade. And early investors who bought industrial real estate or REITs focused on logistics are sitting on 400 to 600% returns, while the broader Mexican stock market returned 80%. Construction companies and building material suppliers are experiencing unprecedented demand, where Cemex, which produces cement, saw revenue increase 45% between 2020 and 2025. Logistics and transportation companies are building permanent competitive advantages because controlling the rail lines, ports, highways, and warehouses that connect Mexican factories to U.S. markets creates monopolistic positions that generate revenue for decades, and companies like Kansas City Southern, which operates the primary rail corridor from Monterrey to Kansas City, are seeing volumes increase 25% annually. Banks financing the industrial expansion are earning massive fees, where Citibanamex, BBVA Mexico, and Banorte are providing project finance, currency hedging, and working capital loans that generate billions in interest and fees. And Mexican bank profits increased 55% between 2020 and 2024, driven primarily by nearshoring-related lending. Energy companies that moved early into Mexico are capturing regulated returns on essential infrastructure because natural gas pipelines, solar farms, and electricity distribution are regulated utilities that earn fixed returns regardless of economic conditions, and private equity funds that invested $20 billion in Mexican energy infrastructure between 2014 and 2020 are now earning 12 to 15% annual returns with 20-year contracts. Chinese exporters are the biggest losers because every factory that moves from Guangdong to Guanajuato represents lost Chinese exports, lost Chinese jobs, and declining Chinese leverage over U.S. supply chains. And Chinese manufacturing exports to the United States fell from $540 billion in 2018 to $430 billion in 2024, a $110 billion annual decline that's being absorbed by Mexico, Vietnam, and other nearshoring destinations. Traditional Mexican agriculture and rural workers are being left behind because nearshoring concentrates in industrial cities, while agricultural regions receive almost no investment, and rural to urban migration is accelerating as young workers abandon farming for $20,000 factory jobs, but this migration creates social disruption, housing shortages, and strain on urban infrastructure that Mexico's government struggles to manage. The pattern always repeats, where industrial transformations create concentrated winners who capture enormous wealth, a broader middle class that benefits modestly, and large populations that gain nothing or actively lose. And Mexico is following the exact pattern that created wealth inequality in China, the United States, and every other industrializing economy where geography, education, and existing infrastructure determine who prospers and who is excluded. History doesn't repeat, but financial patterns do, because nearshoring isn't new. It's the same wealth transfer that built post-war Japan, that industrialized South Korea and Taiwan, that created China's manufacturing boom, And now it's happening in Mexico at a scale and speed that will reshape North American economics for the next century. The math is simple. Corporations need manufacturing outside China. Mexico offers proximity, trade agreements, labor costs, and infrastructure that no competitor can match. And $1 trillion in investment is already committed not as speculation, but as operational reality, where factories are producing, workers are employed, and goods are shipping. The winners are already evident. Border cities, logistics companies, industrial real estate, automotive clusters, and workers with manufacturing skills, while the losers are equally clear: rural regions without infrastructure, agricultural workers without skills, and Chinese exporters losing market share. The question isn't whether nearshoring will happen, it's already happening. The question is who positions correctly to capture the wealth being created, because these patterns create generational fortunes for those who understand them early. And by the time everyone recognizes the shift, the best opportunities are gone, claimed by those who saw the pattern, while others were still debating whether it was real, because the patterns never lie.